Good morning and welcome to Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. And as the major averages continue to hit new highs, where do you find the undervalued opportunities in the market for 2018? Helping us find that answer is Jeff Schulze. He's the investment strategist over at ClearBridge. Jeff, thank you very much for joining us over at MarketSite. And that's the million-dollar question. Where are these opportunities in a market that just continues to move higher?
So even though we're in the 9th year of this market cycle, there are still opportunities out there. And the areas that I think that we're going to find some opportunities here in the first half of 2018 are in some of the areas that are going to coincide with a late cycle economic pickup. So we think energy and financials look attractive right now for a number of different reasons. First off, those two sectors are some of the biggest beneficiaries of tax reform. They're beneficiaries of deregulation, but also they are attractively valued right now. So if you look at financials right now and their contribution to the S&P 500 from an earnings standpoint, it's 20%. But their contribution from a market cap standpoint is only 15%.
Right.
So it's a 5% differential right there. And then if you look at energy, typically outperforms at the very end of an economic cycle. If you look at every cycle going back to the 1960s, energy has outperformed, and I don't think that this time will be any different.
A lot of questions I get from traders are around the VIX, right? So it's at about a 9 handle right now, so the risk is obviously to the upside since it's historically low levels. Do you think stocks can take a shock, if you will, should the VIX go to 14, 15, which in and of itself is not that high of a level?
I think volatility last year was extremely low, and I think it's obviously going to move higher this year. If you think about 2017, the biggest drawdown that we saw was 3%. So it tied the lowest on record going back for the last 40 years. So I do think vol is going to increase, and it's going to increase across a number of different economic areas or financial areas. So first off, I think interest rate vol is going to rise from here. You're going to have the Fed continuing to tighten. You're going to have balance sheet normalization. You also have a firming up of inflation and growth. And if you look at the Treasury, they're going to issue about 65% more debt this year than they did last year. So what that means is higher interest rate vol, but also higher rates. If you think about a higher rate environment, I think the credit markets are going to see more volatility because the cost of capital is going to rise. And the debt servicing capability of those companies is going to get harder. But last but not least, I think you're going to see equity volatility and specifically earnings vol increase. If you look at earnings dispersion last year, it was at a 40-year low. And I think with tax reform as the catalyst, it's going to create winners and losers. Deregulation is going to create winners and losers. And most importantly, if you look at company and analyst estimates, they're all over the place on what this is going to do to the bottom line. So as we move through the earnings seasons of 2018, I think you're going to see some misses and some beats. But that's going to create volatility, broadly speaking. The one thing I will mention, though, is that just because volatility is rising doesn't necessarily mean it's a bad thing. It's where volatility is when that rise begins. So if you look at periods with low volatility and when volatility starts to rise, since the VIX was incepted in 1990, the average market return for the next 12 months has been 9%. It's only when you have high vol and vol continues to rise is when you have those negative market returns.
Tell us about the recessionary dashboard, and are the indicators pointing to a potential recession 2018, perhaps 2019?
Yeah, so we've come up with a recessionary dashboard of 12 variables that do a very good job of foreshadowing an economic downturn. And they look at the 4 major fault lines in the economy. So they look at consumer health, business activity, inflation, and last but not least, financial stresses. And they've done a really good job over the last couple of recessions of calling that top. So during 2007 and 2001, all 11 of the indicators were flashing red, with one of flashing yellow in both of those instances. If you take a peek to where we are today, 11 of them are flashing green, with only one flashing any type of warning sign, which is corporate profit margins.
So that indicates that you don't expect a recession based on this model.
We don't. We think the probabilities are less than 10%. So if we do have that fade, it's going to be 2019 or 2020.
And let's wrap it up with the Fed and global central banks, because there really is a policy shift this year that we haven't seen since the global financial crisis. How well do you expect the markets to absorb this?
Yeah, so we're going from net accommodation, buying a lot of bonds out there, to net issuance. So the differential between this year and next year is going to be over $1 trillion worth of bonds. So that means, in my opinion, that you're going to see rates go up here in the U.S. and over in Europe. But also you're going to see higher volatility as a consequence of that. But we're going from extremely, extremely accommodative to just accommodative, which still should be a nice tailwind for equities next year.
Okay. All right. Well, thank you very much, Jeff, for joining us at MarketSite. And traders, as always, thank you for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.